The truth is simple and terrifying. $2 trillion are sitting in a vault no one can touch, and almost no one understands. Before we go deeper, subscribe, because what you're about to learn doesn't make the news. The economy looks normal on the surface. People shop, banks lend, the stock market climbs and falls like it always has. But beneath that surface lies a machine quietly holding the financial system together. A machine so misunderstood that even seasoned investors avoid talking about it. This is the reverse repo facility, a place where money goes to hide. A place where financial institutions dump their cash because they don't trust the market or each other. This story matters because when trillions of dollars retreat into a bunker, it's never for nothing. Money moves with fear. And fear, institutional fear, always signals danger long before the public ever sees the smoke. To understand how we got here, we have to go back to the moment the financial system broke without admitting it broke. It begins during the pandemic, when the Federal Reserve did what the Federal Reserve always does in a crisis. It opened the fire hose. Trillions in freshly printed liquidity poured into the system like water flooding a cracked dam. Markets were rescued. Asset prices soared. And everyone told themselves the worst was behind us. But what nobody understood was that this flood created a new kind of drought. Too much money, and nowhere safe to put it. Money market funds, corporations, and financial institutions suddenly found themselves holding more cash than they could legally or safely deploy. Interest rates were near zero. Treasury markets were unstable. Lending felt dangerous. And so they did what animals do during an earthquake. They ran for shelter. That shelter was the Fed's reverse repo facility, a tool designed for precision, now used as an escape hatch. Inside this quiet corner of the New York Federal Reserve, institutions could park unlimited sums overnight and earn interest with zero risk. It was supposed to be a temporary tool, a way to smooth over short-term bumps in interest rates. Instead, it became a black hole sucking money out of the real economy. By 2023, it held over $2 trillion in idle cash. And here's where the story stops sounding like economics and starts sounding like a thriller. Because while the world argued about inflation, recession, and unemployment, the Fed was secretly paying billions of dollars in interest to Wall Street simply for keeping their money locked away, draining government revenue, enriching the institutions closest to the Fed, and silently reshaping the financial system without a single vote in Congress. This was never the plan. It was the unintended consequence of rescuing a system that had forgotten how to work on its own. The reverse repo facility became a mirror, reflecting something uncomfortable. The financial markets stopped trusting the financial markets. Banks trusted the Fed more than borrowers. Investors trusted the Fed more than bonds. The entire system trusted the Fed more than the system itself. And that's where the danger begins. Because money isn't supposed to sit still. Money is supposed to move, circulate, lend, build, grow. But when trillions choose not to move, it means one thing. The people controlling that money see something coming. Something big enough, dangerous enough, or unstable enough that even risk-hungry institutions would rather earn a tiny return at the Fed than lend into the real world. The question is, what do they know that we don't? And what happens when all that trapped money decides to move again? Because it will move. It always does. And when it does, the shockwave won't be gentle. This is where the story deepens into the politics, the power plays, the history, and the quiet warnings from past crises that all point to one truth. The reverse repo crisis isn't a technical glitch. It's a symptom of a financial system that has become addicted to central bank control and terrified of real risk. To understand why the reverse repo facility became a financial black hole, you have to go back to the moment the system snapped, the pandemic years. The Federal Reserve didn't just inject liquidity into the economy, it detonated a fire hose. Trillions of dollars were created in months, more than any period in modern monetary history. And that flood didn't behave like past crises. It didn't flow into factories, wages, or small business credit. It didn't rebuild Main Street. Instead, it ricocheted into the balance sheets of the biggest financial institutions in the world, hedge funds, primary dealers, money market funds, creating a tidal wave of cash that nobody knew how to deploy safely. The treasury market was already strained. Corporate debt was bloated. Yields were near zero. Every traditional parking spot for cash was either too risky, too unstable, or too crowded. So Wall Street did what it always does when backed into a corner. It ran straight into the arms of the Federal Reserve. The reverse repo facility became the modern equivalent of a financial fallout shelter, a place to hide from markets that no longer made sense. Overnight, the Fed began paying institutions interest simply to leave money untouched. Trillions sat there, quietly earning, quietly compounding, like oxygen tanks stacked in a bunker while the world outside gasped for air. But here's where the story turns strange. Every dollar that flowed into reverse repo was a dollar that didn't enter the real economy, didn't fund mortgages, didn't support business loans, didn't fuel growth or innovation. It became silent liquidity, frozen capital in the world's largest freezer. And in finance, frozen money isn't neutral. It's dangerous, because when trillions of dollars sit still, everything else has to move violently. As the facility swelled past $500 billion, then $1 trillion, then $2 trillion, a new distortion spread through the system. Markets began orbiting the Fed instead of each other. Money market funds relied on the Fed instead of banks. Short-term interest rates followed the reverse repo rate instead of the organic supply and demand forces they were designed to reflect. The entire short-term funding market, the beating heart of global finance, became a mirror of one institution. Not the Treasury, not the banking system, but the Federal Reserve acting as the world's largest cash custodian. This was not how capitalism was supposed to work. Liquidity was meant to flow. Money was meant to chase opportunity. But in a world terrified of risk, safety became the most profitable business model. And safety always comes with a cost. Because for the first time in history, the Federal Reserve began paying billions in interest to Wall Street funds, while simultaneously losing money. The same central bank that created the liquidity was now paying institutions to hold it hostage. The result? A stealth drain on government revenue, a quiet subsidy for the financial elite, a widening gap between institutions and ordinary savers. People saw inflation, but the system saw something more dangerous, a growing addiction to the Fed's safety valve. And addictions always end in withdrawal. The question wasn't if, it was when. Because at some point, the trillions parked in reverse repo would have to leave. And when they did, they wouldn't walk out gently, they would rush. Like water surging through a cracked dam, hunting for yield. Chasing treasuries, corporate bonds, equities, real estate, anything with return. That flood would push rates down, then up, then down again. It would destabilize funding markets. It would compete with the Treasury for capital. It would force banks to reprice risk overnight. It could trigger the next liquidity crisis out of nowhere. And the Fed knows it. Behind closed doors, research papers quietly warn that the reverse repo facility is a structural distortion, a concentration risk, and a point of instability. Not because it's broken, but because it worked too well. Too much money, too few safe assets, too deep of a dependency. A safety valve turned into a trap. And now, the world waits for the moment when the frozen liquidity begins to thaw. When the trillions begin to move. When the markets, after years of artificial calm, finally meet the real cost of fear-driven economics. You can hear it in the speeches. You can see it in the balance sheets. You can feel it in the quiet tension of every Treasury auction. Something is building. Something the public doesn't see. Something Wall Street sees too clearly. Because markets don't break when money disappears. Markets break when money returns all at once. And the fuse is already lit. The story of the reverse repo crisis doesn't begin with spreadsheets or traders in Manhattan. It begins with something far more subtle, a system drowning in its own money. For decades, Wall Street begged for liquidity. In 2020, it finally got its wish, and then discovered the nightmare of having too much of it. The pandemic didn't just shut down cities, it broke the traditional flow of cash. Banks hoarded reserves. Households saved at record levels. Corporations raised debt as if every day were their last. And in the middle of that panic, the Federal Reserve opened the floodgates with the largest money injection in American history. Trillions poured into the system. But unlike water flowing into a river, this money didn't circulate. It pooled. It stagnated. It collected in corners of the financial world where it wasn't supposed to stay. And that's where the reverse repo facility turned from a niche plumbing tool into a black hole. A place where cash vanished not because it was stolen, but because the system didn't know what to do with it. Money market funds, terrified of risk, refused to lend into the real economy. Banks didn't need more reserves. Investors avoided treasury bills that paid almost nothing. So all this cash, this raw economic energy, went searching for safety. It found one counterparty that never defaulted, never flinched, never hesitated: the Federal Reserve itself. That was the moment the reverse repo system became the quiet center of the global financial universe. Trillions parked there every single night. Not for profit, not for strategy, for survival. But here's the part almost nobody understands. When trillions of dollars circle back to the Fed instead of flowing through the economy, the system starts to resemble a patient whose blood refuses to circulate. The heart beats, the arteries exist, but the flow is missing, and missing flow is missed life. And yet the Fed pays interest on this frozen liquidity, billions, quietly, automatically, to institutions not because they took risks or funded growth, but because they refused to. A safety subsidy, a reward for caution, a tax on dynamism. This irony is almost poetic. The central bank that spent years injecting liquidity into the system is now paying trillions to get rid of the very liquidity it created. The cracks become clearer when you zoom out. A trillion parked overnight is not a sign of confidence. It is a message, a silent alarm, that the system mistrusts itself. Treasury markets feel the strain. Credit markets feel the withdrawal. Investment hesitates. The real economy suffocates. And while this happens in the shadows, everyday Americans wonder why wages stagnate, why borrowing feels harder, why their cost of living rises while the financial world insists that liquidity is abundant. It is abundant, but trapped, frozen in the Fed's vaults, locked away in a safety mechanism that was never designed to be permanent. Wall Street calls it technical. Economists call it temporary. But the truth is simpler. You cannot freeze $2 trillion without freezing part of the economy itself. And that's where the danger begins. Because every frozen system eventually faces a thaw. Nobody knows when this money returns to the market, only that it will. Nobody knows what asset it targets first, only that it must target something. And nobody knows how the treasury market absorbs that tidal wave, only that it has never been tested like this. The system is quiet now, calm. But calm isn't stability. Calm is the surface of a dam holding back a lake. And then comes the moment nobody wants to think about, the moment the dam breaks. Because $2 trillion sitting perfectly still is not normal. It's not healthy. It's not safe. It's pressure. It's trapped energy. And the longer it sits, the more violently it wants to move. Imagine this. Money market funds suddenly find higher yields elsewhere. Institutions stop needing the Fed as a parking lot. Treasury auctions begin demanding cash again. Slowly at first, then all at once, the money begins to drain out of the reverse repo facility. Liquidity slams back into the system like a tsunami. Short-term rates swing violently. Repo markets tighten. Leveraged players scramble for collateral. Treasury yields jump, then collapse, then jump again. And in the chaos, the same institutions that hid inside the Fed's safety net suddenly find themselves exposed. Because trillions exiting the facility doesn't just go back to work. It forces every major market, from corporate debt to mortgages to derivatives, to reprice in real time. This isn't a gentle unwind. It's a liquidity shockwave. The last time the pipes rattled was 2019. This time they're holding more pressure than at any point in modern financial history. The $2 trillion problem is not that it's sitting. The problem is what happens when it finally moves. And deep inside the New York Fed, every economist, every liquidity analyst, every risk model knows the same truth. They can manage a flood, but not a stampede. So when people hear the phrase reverse repo facility, their eyes glaze over. They assume it's just another technical corner of finance, a tool for banks, not for them. But behind that dull name is one of the most important stress points in the global economy. Because every dollar parked there is a dollar not circulating, a dollar not lending, a dollar not investing, a dollar held hostage by fear, inflation, and uncertainty. This facility is a mirror. It shows a financial system that no longer trusts itself, one where safety becomes paralysis and paralysis becomes fragility. The same fragility that has preceded every major modern crisis. The repo crack in 2019, the liquidity freeze of 2008, the savings drain of the 1970s, the silent collapses nobody remembers, but markets never forget. And whether this story ends quietly or violently depends on something no model can fully predict. When the world decides it no longer needs the Fed to babysit its money. When that moment comes, the unwind won't just be technical. It will be psychological. A shift in trust, a shift in confidence, a shift in the balance of power between central banks, markets, and the people caught in between. So yes, the reverse repo is a tool, but it's also a warning. And every day that $2 trillion sits in that vault is another day the warning grows louder. If you want more deep dive documentaries that expose the real machinery behind money, power, and crisis, subscribe. The next episode goes even deeper.